What's going on, everybody? Liam O'Reilly, Vermont Economic Realtor with Jerry Riley Real Estate. I hope you're doing well. Today, we had a loan officer come in and speak at the office. Somebody from a local bank around here who was pitching some of their portfolio products for residential purchases. Now, for those of you that don't know, most mortgages that when you purchase your standard home that abides by Fannie Mae and Freddie Mac guidelines, they get sold on the secondary market, packaged into mortgage-backed securities, and purchased by investors. Now, what this loan officer was coming to speak with us today was about their portfolio products, which means the loans that this bank originates themselves and keeps in-house. And what's really unique about these products are they're better than Fannie Mae and Freddie Mac products in a lot of ways. So, what I'm going to be talking about in this video is why are banks, smaller banks, which is what this bank is, offering these products. I've heard of other banks doing it around the area too. So why are they doing that? Why are they competing against mortgage-backed securities when they can, or Fannie Mae and Freddie Mac when they can just go and purchase these mortgage-backed securities? And what does that mean for you as a home buyer? This video isn't going to be focused so much on sellers, but it's more for the buyers. So as far as what this bank offers, and if you want to know the specific bank, for some reason they didn't want to put their bank name on the marketing materials that they gave us, so I'm not going to mention their name in this video. But if you want to know the name, just reach out to me directly. We'd be happy to give you the name of the bank. But they're offering no closing costs, legitimately no closing costs. Besides, there's a property transfer tax here in Vermont. The buyers pay that, but other than that, they pay your lawyer's fee, they pay your appraiser. They really take care of everything. No closing costs. They'll offer 30-year fixed rate loans on market rates, pretty much, with 97% loan to value, significantly reduced PMI, and no PMI at 10% loan to value, which is just, if you want to know more about these numbers, reach out to me. This is a little specific, but anyway, these are ridiculous numbers, and I can send you everything. I can give you this bank's contact information if you're interested. Reach out to me, but it's way better than Fannie Mae and Freddie Mac. So why are the banks offering this? Now, I'm going to bring up a couple different articles here. So when the Federal Reserve spoke last in their last meeting, they talked a lot about bank tightening and how lending was going to essentially hike rates for them, that they didn't need to hike rates again because banks were going to tighten up their lending standards and not be lending as much money into the system, which, they're not going to be creating as much monetary supply, which should reduce inflation. At least that's how I understand it. But so it's a little confusing when you see smaller banks like this that have made headlines recently as banks that might start having issues. When they start to offer products that are more attractive, it's a little counterintuitive. So let's explore that today. Now, the one thing I wanted to say right off the bat is when I went to research this topic, there wasn't a whole lot of information that's from this week. This is from 2 weeks ago, talking about how banks are tightening their lending standards a month ago. This isn't even really about it. What new owners should know. Banks report tougher credit standards in the wake of failures. So just articles from the past weeks talking about how banks are tightening their lending standards. And then if we go over to this video here that I was watching on Eurodollar University, they talk about this article here. Bloomberg, Bill Ackman backed builder says 48 lenders rejected an apartment project. So they pitched 48 banks on this apartment project, and all of them rejected them. None of them showed up to the meeting. You can watch the video. I'll leave the article in the description there. But basically, none of them showed up to the meeting and weren't actively trying to lend. And if we go over to Redfin here and we look at what's going on with rents, this is new permit starts as far as rents go. And what Redfin states is that apartment buildings, 5 units and up, have seen a 22.9% decline in new permit issuance, seasonally adjusted, for year over year. So basically, people aren't building as many apartment complexes as they were, and I think a big part of that has to do with the commercial banks and the tighter lending standards. Now, so that's kind of what's going on in the commercial banking sector, and the reason why I focused on commercial lending right now is because typically those are loans that are held on the big banks' balance sheets, or medium banks or small banks. When somebody wants to build an apartment complex, that's not going to fit into Fannie Mae and Freddie Mac's guidelines. They need to go to a small bank and receive funding from that bank. But now these banks are tightening their lending standards on these apartment complexes and on these commercial projects, while at the same time they're loosening their lending standards and trying to be more competitive than Fannie Mae and Freddie Mac on their residential mortgages. So what's going on in that end? When we look at what is happening with residential mortgage-backed securities, this website tracks the issuance of mortgage-backed securities. So if we look at what's going on, we can see that mortgage-backed securities are down significantly year over year, which these past few years they've been down historically as well. But if we look at what's happened from the beginning of the year, we had let's see, agency MBS. So if we look at it, it looks like right around 70 to 80 billion dollars in MBS in January, probably about 60 to 70 in February, and then now we're right around 100 in May. Compared to, if you look at May last year, we were over 150 billion in mortgage-backed security issuance. So there's less mortgage-backed securities being issued as a result of higher rates, right? So less people are refinancing, because mortgage-backed securities aren't only issued from new purchases. If you go to refinance your home and use Fannie Mae and Freddie Mac guidelines, those get packaged up and sold into the mortgage-backed security market as well. So higher rates are slowing refinances, which are stopping the issuance of these mortgage-backed securities, but also, the lack of sales volume that we've talked about on this channel many times. Overall, housing sales are way down. So the last article that we're going to talk about, and I know I'm getting to the end here where I'll get to my point, but this article talks about how they're issuing less mortgage-backed securities because there's less sales. But at the same time, the Federal Reserve is not stepping in and purchasing any of these mortgage-backed securities. So, according to Amherst, which has been researching the Amherst Group, which this article cites, there should be a net increase in mortgage-backed securities that need to be scooped up by investors. So, let's see here. If we get here, I'm just trying to find the section of the article where they state that. I'm going to leave this in the description. You can go over any of these articles and watch the video that I mentioned as well. All right, so right here, even though agency debt is to decline from 530 billion in 2022 to 325 billion this year and 375 billion in 2024, the added mortgage-backed security supply created by the Fed's quantitative tightening, which is just the roll-off of their balance sheet, will effectively increase the overall supply of mortgage-backed securities that needs to be absorbed by the private market, compared to with even a banner year of 2021, where they had a record number of issuance that needed to be absorbed by investors in the market. So what does all this mean? Right? So we have an excess number of mortgage-backed securities. So essentially, if these banks didn't want to offer their own portfolio residential products at a more competitive rate, or not rate, but at more competitive terms, right? It's no PMI, 10% down products, no closing costs. They're paying your attorney's fees. They're paying your appraiser. Those are significant costs that the bank is taking on, and essentially trying to attract new customers, trying to attract you as the home buyer when they don't really need to, because there's excess mortgage-backed securities in the market that need to be absorbed by investors, which have historically been banks. So why are they doing this? I mean, the only thing that I can think of as to why they would be doing this is they probably have a portion of their portfolio that they want to have in-house, that I'm sure they're still buying mortgage-backed securities as well, at least the well-positioned banks. And I mean, I'm sure banks that aren't well-positioned aren't purchasing any mortgage-backed securities and aren't offering these great products for home buyers. But the ones that are doing okay, the smaller ones that have decent balance sheets, they don't want to put their money into commercial real estate right now, and they don't want to put their money into funds, because those are riskier investments. Even though they generate a higher interest rate, they're still a little bit riskier, and they don't want to have all their money into mortgage-backed securities because they want to have a diversified asset portfolio. I think, again, this is what I'm talking about now is speculation as to why they could be offering these products. So because they don't want to keep as many commercial portfolio products on their books, and they don't want to be over leveraged with mortgage-backed security products, a good option for them is the single family home buyer, because that type of buyer is likely to continue to repay, is unlikely to default, historically speaking. And so to attract this type of loan, to keep this type of product on their books, they're offering better terms than Fannie Mae and Freddie Mac, because that's their competition. And so for whatever reason, they want to have these single family home buyers, and not even single family homes, but just products that would traditionally fall into Fannie Mae and Freddie Mac, like secondary homes or camps are offered by this bank as well. 2 to 4 unit properties. I mean, they're really great deals. They're really trying to attract these customers, and I think the reason is they want to have a more diverse portfolio on their bank. Now, what does that mean for you, or on their balance sheet? Excuse me. What does that mean for you as the home buyer? Well, I think it means that if you're looking in Vermont, I would recommend talking to me, asking about different lenders, because this bank offers great products, but there's a few other banks that I would recommend calling as well to see what they're offering. If you're looking in another state, I would say reach out to local banks and reach out to realtors to see if they've heard about any of these products from local banks. You want to call a variety of lenders when you're going to purchase a home to see what products they offer. Not all lenders are the same. Not all lenders offer these products. Not all lenders offer this 10% down, no PMI product, even for 2 to 4 unit properties. That's pretty unheard of. That's something that you can't get with Fannie Mae and Freddie Mac. That's something that not every bank offers. So you're going to want to call around. You're going to want to talk to these different loan officers and see what product works best for you. And a great resource are realtors, because lenders know that realtors work with buyers all the time. And so lenders come and pitch us their products and try to sell us on the products that are most attractive to pitch to you folks, to pitch to home buyers. So, realtors are a great resource as to point you into the right direction. And then the loan officer that you speak with will be able to give you more information about their products and tell you, if you really fit into the products that they offer. So call around, go to local lenders, see what they're offering right now, because lending standards are tightening among banks. But if you're in the market to purchase a home, banks want you on their balance sheet. They want you paying them directly for some reason, as opposed to going into their mortgage-backed security pool. So anyway, Lee O'Reilly, Vermont economic realtor. All my contact information is in the description. If you're looking to buy or sell a home, either in Vermont or across the country, reach out to me. I would be happy to help you here in Vermont. Happy to find you a great realtor across the country. Leave me a comment. Let me know what you think. Why, do you agree with me as to why these banks are loosening their residential lending standards while it appears that they're tightening their commercial lending standards? Would love to know your thoughts in the comments below. Other than that, I'll see you guys in the next video.